Hi, my name's Chris Tubby. I'm founder of Trading for Tomorrow, and as usual, I'm just giving my macro outlook and then a bit of analysis on some of the products that I trade. Hope you enjoy it and it is insightful, so hope it helps you with your trading. Okay, so, well, what an exciting week we had last week. You know, the Fed finally starting to cut rates, and by more than most people predicted, but of course not me. You know, if you've been following me here on YouTube or LinkedIn or subscribing to my daily newsletter, you'll know I've been expecting this 50 basis point cut for months. Now, the question now is how many further cuts will there be this year and indeed in 2025. And of course, that's going to depend on the data, jobs, inflation, and even how consumers perform. Now, as I mentioned before, data is generally lagging, and even more so, it's questionable. Just recently, the Bureau of Labour Statistics revised down the jobs created between May last year to May this year by over 800,000. And surveys are even more unreliable. When the response by corporations or households is below 50%. In some cases, it's just over 30%. And of course, who's filling in those forms? Who's giving that? And are they actually putting any effort into giving accurate assessments? Yet, we use this data to trade, to invest, and obviously assist us in our macro outlook. So, I've been questioning this for a long time now, and some of it is fairly accurate, some of it is not so accurate. So, you just got to be aware of this and read into it what you want to. Now, also central bank wise, Bank of England kept rates unchanged. Personally, I think that's a mistake, and they should have actually cut by another 25 basis points. I'm in the UK, the economy is holding up okay, but when you look at the cost of things, it's all risen by over 20% since COVID, and food even more. And that's obviously not just the UK, that's everywhere. Now, the Bank of Japan also left rates unchanged, although they are likely to hike, emphasis on hike, once more this year. So central banks are making the right choice of jobs over inflation as far as I'm concerned. The latter may sort of not quite be at their 2% target, but for me it's close enough to ensure that what they don't want to do now is take their eye off the ball, focus too much on inflation and miss the fact that the economy is actually weakening. But because then there's that obvious likelihood that it could fall into recession. There'll be more rate cuts from most central banks next year, although I believe they will bottom out around 2.5%, 3% in 2026. I wouldn't expect all this cheap, ultra cheap money, in fact, to reappear. It's just not going to do it. They've been scared by inflation, so that's going to remain with them. And they're going to be cautious of lowering rates too much in case, of course, get the same situation again and another big drive of inflation. Of course, one big concern, the debt levels, they're already way too high. Global debt is above $315 trillion. And public debt makes up around about 100 trillion of that. Now, the US government debt is over 35.3 trillion. So, is there ever going to be a payday? How does this all reset, or how does this get paid down? Because at the moment, it just looks as though these numbers are just getting bigger and bigger and bigger. Of course, inflation helps actually to devalue debt. So, that there is a little bit of a payoff there. And of course, then you've got to think about this new shadow banking debt, all these buy now, pay later schemes, etc., because that stands at another $1.7 trillion. But I'm not sure if that's actually sort of already included anywhere or not. And of course, it leads to the question of, will debt be the next crisis? Or will it be caused by geopolitical conflicts? We've got this Russia-Ukraine still going on, which, unless Ukraine sort of agrees to concede territory, which is unlikely, it seems destined to sort of escalate more. I mean, there's potential for Ukraine to be firing quite a few long-range missiles into Russia, and Russia, well, who knows what Putin's next steps would be after that. Then, looking at Israel, I mean, there's been a lot going on with missiles flying backwards and forwards between them and Hezbollah the weekend. But Israel's using sort of these electronic devices to hit individual members of these terrorist groups, and obviously continuing to attack areas in Gaza. And, okay, they're sort of launching missiles into Lebanon now, but could it soon include ground troops as well? Now, 2 Hezbollah top military leaders were killed, and of course, as I say, there's been plenty of missile strikes into Israel to retaliate, and Israel hitting back, firing missiles into Lebanon. This war just seems to be, getting going, sort of warming up, if you like. Obviously it was Hamas to start with, and then the Houthi got involved in the Red Sea. Now we've got Hezbollah, and Hezbollah has the largest private army in the world. And of course, this could escalate more. And if it does, then that's going to make the Middle East an absolute minefield. And pretty much could close off the Red Sea. Now, that part of this has sort of steadied oil during the week. It closed above $71 for WTI. Now, although the conflict is in the Red Sea, and because it's in the Red Sea, it's more likely, well, it will have a bigger impact on Brent. So just keep an eye on that. Looking at some of the other markets last week, gold hit yet another record high, trading above 26.50, and stocks traded higher. Friday was quad witching with stocks and indices expiries. Of course, that sort of usually that's actually really can sort of bring out a lot more volatility, but to me it just seemed as though it was almost a bit subdued really this time round. And of course the dollar just cannot gain any ground. And of course, this is because traders expect the Fed cuts to be more aggressive than others, and everyone's focusing on yields. Personally, I think it's sort of a bit short-sighted. Surely if the US are cutting rates, okay, there's a bit of a risk with jobs and that, but they're cutting rates because they feel that they've got inflation under control, and they've still got a healthy economy and expecting a soft landing at the moment. And of course, now they're starting to cut rates, they may get away with that. So, whether the Fed will stay and cut a lot, I don't know. I think 1 or 2 more rate cuts this year, and then there'll be some next year. But as I say, we can't expect these rates just to keep dropping and dropping. There's going to be a base of about 2.5% to 3% on them. Now, for me, I just think that the dollar's getting too cheap. But just remember, that's my personal view, and I am a big fan of the dollar anyway. So, just treat that with caution. That's not a recommendation at all. Now, Bitcoin recovery continued, and that was trading over 64,000 on Friday. So again, good bounce from where it got to. It's about 10,000 off the lows. And next week is PMI week, with many countries releasing their PMI data. There's just a whole mass of data out from everywhere. But my focus will be Friday's US PCE, because that obviously is going to help to for us to understand if at the next meeting the Fed's going to cut again, and if so, by how much. Now, there's a plethora of central bank speakers this week, and also there's a couple of rate decisions from Switzerland and Australia. So that's pretty much it with the macro. What can I say? They've started the rate cuts. Obviously not everywhere because Japan's putting theirs up slowly. And probably 2025, 2026, you're going to probably see that equilibrium between most countries. They're all going to sort of converge potentially. So, right, now stay with me. There's another couple of slides and then I'm going to go into some analysis for you. Now, I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. This will help you to discover if trading could be your next career or even just a second income. Otherwise, maybe you're already trading, but there's a few gaps that you'd like to fill in, and I can help you with that because that will accelerate your trading and your performance. And then there's a 1 week intensive course. That's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And if you've got that inner trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up. You don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market and also on any asset class. I trade them all. And as I say, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And this is to help you reach that next level time and again. And I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now, rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as I mentioned earlier about the trading challenges, if you're looking for a funded trading account, then you can contact me for details just about the ones that I use, or you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice and do that before you risk your capital. So many people come and find me after they lost money, which is sad. They should come to me before. And yeah, so listen, that's it for part 1. I hope to see you in part 2, where I'm going to do some technical analysis.